The European equity market is no longer cheap, but with a broad global recovery underway, there are still many income opportunities out there. That's according to our next guest, who joins me to discuss how to invest in dividends in 2018. Matt Williams is a director in BlackRock's European equity team. Thanks for joining us. So I wanted to try and weave in your stock picks as much as possible. But before we get into that, let's start with the macro picture. Clearly, the European economy is in rude health, or at least it's doing a lot better than it has been doing in recent history. How does that play into your income picks, particularly in terms of sectors?
So I think at the moment you're absolutely right. The world, we're seeing this global synchronized growth. Europe, domestic economy is recovering quite nicely. We're at much less of a two-speed economy than we previously have been. At the same time, European companies have always been able to get earnings growth and dividend growth from the rest of the world. So I think your starting point at the moment has to be positioning even an income fund to share in this recovering world, albeit from a conservative standpoint. That then brings us on to the shape of the market in terms of yield and otherwise. And at the moment, we would say that high yield within the equity income space, high yield is probably more a signal of dividend risk or of low growth. And so within our flexible portfolio, the Continental European Income Fund, we're looking much more at capturing dividend growth than we are in trying to find high yield, where we do see some dividend risk or low earnings growth.
So I'm going to move on to the high yield piece in a minute, but just before we do that, you said you're very bullish on the French economy particularly. How do you play that through dividend stocks?
So there's two ways within the French context. The first one is obviously to recognise that France is recovering economically, in the same way that the rest of Europe is recovering. And secondly, you have the advantage with France of the potential for political reforms. So you can divide it kind of into two ways. The first way is to look at some of the French infrastructure type names, like some of the toll road operators. These would be companies like Vinci, like Eiffage, those kind of guys who are possibly not the growthiest in the world, but they are recovering as a result of that. And because they are infrastructure type names, they have been at a relative valuation discount of late. And then the second side is more the construction type infrastructure names, where you've got maybe a little bit more cyclical growth coming through, and that would be companies potentially like Bouygues. And that gives you a combination of exposures within the same industrials bucket. But the important thing about the strategy and about the fund at the moment is really about capturing dividend growth as much as anything else.
The consumer sector was one that you mentioned. One particular stock was Deutsche Post. What's the rationale there?
So when we look at the consumer sector, you have to bear in mind this strategy has to have an ex-ante beta of less than 1. So we automatically exclude some of the more cyclical type names, which are hard to get into that portfolio, the autos and similar. When you think about Deutsche Post, they have invested in a more customer-friendly interface. They obviously have exposure to a recovering consumer in terms of parcels and packages and so on, and they have a renewed focus on free cash flow generation. Just because we're focusing on dividend growth doesn't mean that we can forget about free cash flow, and doesn't mean we can forget about dividend reliability.
Let's switch to the riskier part of the market now, high yield. How do you define high yield at BlackRock?
So we don't have a preset number, and the point of this strategy is it's incredibly flexible in that we are able to tilt the portfolio between dividend yield and dividend growth. We aim to deliver 110% of the yield of the index. What we are finding at the moment, as always, as the dividend yield rises, the reliability of that dividend normally comes into question. And at the moment, where we see things that have a high dividend yield, that is very definitely a signal likely of either increased dividend risk or of low earnings growth. In other words, it's a function of the valuation. You can find some things there which do still have attractive dividend yields. You can certainly find companies within the insurance space. Insurance is possibly not the growthiest at the moment in terms of dividend growth, but you have attractive dividend yields somewhere around about 5%, and attractive free cash flow yields supporting that around about sort of 7.5%. So you can find high yield, but you have to be very, very careful about that, because the days of lots and lots and lots of mispriced quality yield are no longer with us. One
name you mentioned was Telefnica.
So Telefnica has done very well for us in the portfolio historically. It does have a yield in excess of 6% historically. It also has benefited from spending its money on R&D, so it continued spending its money on investment. So it continued building out its fibre network, and that is one of the few places you can find a above average dividend yield at the moment, which is a rare animal to be able to find where you have the dividend yield and the reliability, which is quite important. It does capture, from our point of view, the importance of being selective in high yield. You can find it, and then we're looking at capturing businesses who are benefiting from investment-led growth across the world, and they fit into that.
The outlook for emerging markets is very strong into 2018 on the street. What's your view on stocks with exposure to EM? Too risky?
It's not a question of risk in that regard for the income strategy. As always, we're constrained by the beta. So if you think of the natural kind of companies that have massive exposures to emerging markets, you're thinking about metals and miners, you're thinking about the commodities complex, you're thinking about the car companies. These companies tend to have very high betas, and that makes their inclusion in the Continental European Income Fund rather difficult. The flip side of that is that you can find very decent consumer exposed names with emerging market exposure. One stock that did pretty well for us last year was Adidas, which is also interestingly a beneficiary of a rising euro. So you can get exposure to emerging markets through the Continental European Income Fund, but you can't get as much exposure as if you didn't have the beta constraint, and you obviously can't at that point invest in some of those commodity complex names.
All right, so Adidas, Telefnica, Deutsche Post, lots of different names there. Thank you for joining us. That was Matt Williams from BlackRock. Thank you for joining us. I'm Victoria Scholar, and we'll see you very soon.
Subscribe to IG for educational content, company insight, financial analysis and expert commentary.